Retirement Lifestyle Show is back with a very special episode. The reason why this is a very special episode is my fellow co-host Roshan Loungani is back. So now more than ever, I'm super excited for this episode. Roshan, welcome back.
Thank you very much. I'm really happy to be back, and this should be a continued thing. Last year was a little crazy in terms of what work just being really, really busy, and I'm happy to be back to normal and back on the episode. I'm looking forward to this.
Yeah, I'm sure our viewers and listeners are happy to have you back. I mean, while you've been gone, we recorded a bunch of different episodes on financial planning, investing, the markets, and the economy. So I'm assuming that trend's going to continue this year. So, like I said, we're happy for you to be back, and you have the topic today. So the floor is all yours, and I can't wait to record another episode with you. I'm looking forward to it.
As am I, as am I. And the topic today is for those of you who've been watching the markets. I'll start actually with our disclosure. This is not advice. This is just discussion, research, ideas. That's about it, but not advice. We're not telling you to buy or sell anything, particularly in this case. And I put it that way because I have not made any moves in terms of buying or anything like that in this space. But for those of you who've been watching, the software sector has been absolutely crushed this year. As we record this, it's down about 23% in 2 months, roughly. So so I started looking for opportunities there. And I just want to walk you through the process, get your thoughts and ideas along the way, and I'd love to discuss it further. But what I did was I started with uh, first I ran a stock screen just for companies in the sector. Now, in that screen, I didn't want to screen out much. It was mainly looking for stuff in the sector. And then I did have various data points I wanted included in the screen. So what I was looking for. Those data points were return on equity, trailing PE ratio, forward PE ratio, PEG ratio, trailing and forward. Now, and let me explain this. PE ratio is price to earnings ratio. How much are you paying uh, per dollar of earnings? So, for example, if a company's earning $10 a year and you buy the stock for $100, you're paying 10 times earnings. The price of 100 divided by the earnings of 10. So that's a 10 PE ratio there. And the forward PE ratio looks at what do you expect next year's earnings to be. Now, the PEG ratio then takes growth and it divides the PE ratio by the earnings per share growth. So what I'm looking for here is why I'm looking at these different areas is I'm looking the PE ratio and the PEG ratio. I'm looking at because I'm trying to see are the stocks selling at a good price. The return on equity is is more an efficiency of the company. It's you take the income, you divide that by shareholders' equity, and how much profit is the company generating per dollar of equity. So if the company's generating, and I'm keeping this simple again, the company is net income is $10, and let's say the total shareholders equity is $100, then it's generating 10% of ROE, return on equity. That tells me how profitable the business is, right? How well it speaks to how well run the business is, and theoretically what would they do with my money if I'm investing in this company? I'm giving them my money. How much can they grow it, and what should I expect? So you're not going to get exact growth based on the return on equity. There are other metrics to look at as well, but once at this point I'm just in a screening phase where I'm trying to narrow down my list. So Adrian, what questions do you have there, if any?
So I definitely don't have any questions right now. I see the direction that you're headed to. I guess what we could probably do is just give a little bit more background with people that are probably not familiar with what's going on. Maybe they see the headline that you mentioned, probably, which is the most common one: software stocks are down, they're getting beaten up. And the main reason why they're getting beaten up is you're starting to see artificial intelligence, which people are starting to predict, like last year and the year before that, is starting to impact some of these companies. And as we're familiar with, like software stocks for over the past decade, that's been the area where people go for growth in their portfolio, these big returns, because these software companies have high multiples. They make a lot of money. They have sometimes the biggest and strongest like outlooks compared to most companies. Investors are willing to pay a premium for their stock because they think these are going to be some of like the best stocks because they performed so well. So fast forward to this year, you have artificial intelligence companies, new artificial intelligence products and services that is kind of threatening their business models, so to speak. Where now investors, analysts, Wall Street in general is starting to question a lot of these companies. Is AI going to replace some of the service and products that they provide to hundreds, if not thousands, of companies in America? Are they going to become obsolete? Are these different companies and different sectors and industries going to look for these new AI service or products to continue to grow their business? Are they going to go somewhere else? So I'm definitely in the camp of, I think some of these software companies are going to be fine. They may have to adjust, but over the long run, they'll be okay. But there are going to be some that, aren't going to be able to keep up and maybe lose some of the contracts or some of the business that they've had with some of these companies that they've enjoyed for decades. And then the other piece of background I will add on this that you probably know about with these software companies is this like private like credit and like loans, where some of these like software companies are like highly leveraged or they have these loans. So if they're at risk of being replaced and they have all these loans, it's kind of like a disaster as far as like their business. So that's kind of like the background on why these companies are down and how they, what you talked about, Roshan, how they came across your radar. Because if they're a good company and their stock price is down, it makes sense to look into them to see if they're a good investment for the long term.
And that's what I'm trying to do. So, uh, Adrian, you did a great job summing that up, right? The risk of AI, the SaaS firms, software as a service is what it stands for, are the ones that are taking the hit. And what I'm trying to find are companies that I think um, I think this AI decline is overdone, right? And I really don't know, right? With a lot of these, so I'm trying to find businesses that I think are good businesses that I think will be able to get through the AI risk. So that's what I'm trying to find with this screen is yeah, there are going to be some companies, I don't know which either in this case, but there are going to be some companies that this will cause them to go out of business, right? I don't think that's um unreasonable. And there are other companies where the old colloquialism of throwing the baby out with the bathwater. I'm trying to find the baby and see what we can invest in. And as I said at the beginning, this is definitely not investment advice, and I've not done anything, in terms of this, aside from running this screen to narrow down the list of companies that I'd be interested in. And a lot of this is definitely about how to manage your time as well, right? So I did that. I started with the stock screen, and then there were some names that I expected on the list that I didn't see. That stock screen took me down to roughly 100 names. The next step I did was I took all the holdings in the software ETF. And as I've mentioned before, and I'll keep mentioning, this is definitely not a recommendation to buy anything. The ETF I use, because of the decline, the symbol's IGV. It's the iShares Expanded Tech Software Sector ETF. And the reason I picked that is because it represents the sector. It's been down, and it's actually been the one referenced and talked about the most as far as I've seen in the financial press. So I then looked at all the holdings in there. They're about 120. So I'm starting out with 220 roughly lines on my spreadsheet that I'm looking at. But there are definitely names that overlapped, and then I started just deleting and paring down things. So when I started deleting deleting things, well, one, the duplicates, any names that were duplicates out there. I also then looked at companies that were selling at either a valuation level that I thought was way too high. There were maybe return on equity numbers were way too low, and then I started looking at, well, what are all the analysts saying about the companies? And I'm using this to narrow down. And not, once again, I'm still not buying or selling anything based on this. As I've said, I haven't bought or sold anything. But once I narrowed it down based on return on equity and my valuation, for those of you who are longtime listeners, you'll know that what I typically am looking for are good businesses selling at a good price. And as a starting point, I'm using the return on equity as a good business, and the price to earnings ratio or PEG ratio, either or both of those, for the good price side of the equation. And then what I'm looking for on the analyst side, it's not that I think they're right or wrong. It's just to help me narrow down the list. They've spent time looking into and researching these companies, and I'm trying to get down from a list of I mentioned roughly 220, excluding and there is, as I said, overlap names, down to something manageable that I can research. Once I've gone through all those screens, I ended up with a list of 16 names. I then dug very quickly deeper into those 16 names, now adding in additional data points, historical return on equity, historical and forward PE and PEG ratios, market cap. I also, as I've talked about previously, do like to write covered calls on these holdings. So covered calls are a way to generate income. What you do is, if a stock's selling for $100, you can sell the right to someone else to buy it from you at, let's say, 105 or 110. They'll pay you 10, 15, 20 cents for that right per share. And what that'll do is that'll generate income in your portfolio. The downside of this is, if the stock goes through the price, if I sold the right at 105 and it shoots up to 120, well, my gain was capped at 105. The upside is I collect that income along the way. I personally feel more comfortable uh, doing that, because to me that's a way to manage the risk. So then I did look at, well, which ones have these weekly options available to generate income. I added in market cap, because I'm looking for companies where there is going to be some liquidity, where you'd be locked in. So I wanted medium to large companies. And once I did that next step, now I'm down to a list of 12. And that's currently where I stand. I've got 12 names that I've got to spend time looking further into to determine if I want to invest in them. And I have these names sorted. I'm going to look at them by what I think is, using my good business side, not the good price side. I'm looking for companies that have good returns on equity. And I'm also looking at using my own opinion and thoughts on it as well. So, like, just as an example, um, let's use like Microsoft as an example. There's a lot going on there. And as I keep saying, this is not a recommendation to buy. I have not bought, but on this software as a service comparison. And as I said, there are other issues going on with Microsoft, not just the AI risk. but I don't see the world moving away from Microsoft Office because of AI, right? So I think we're still going to use Word, Excel, PowerPoint, etc., even though AI is there. So that's one where, yeah, I'm using my opinion as well, and it met all the criterias with the numbers. But where my opinion's coming into play is that might be one of the names I research first, even if it's not the highest return on equity. Another name on there that is pretty high on the return on equity list that I'd probably look at towards the end is Oracle, because there's been so much talk about how much debt they're taking on. And uh, what I'm trying to do with narrowing down these lists is manage my time. Where do I feel like I'm most likely to end up with something I'd want to buy? And yeah, and with my opinion on Microsoft and Microsoft, I believe at this point my likelihood of finding a buying opportunity is higher there than Oracle, with everything I've read about their debt issuance, right? So that, at this point, I've spent the time to take the list down to a manageable list for what I can look into and research, and it's about spending time now researching them to see if I can come to a place where I feel like I could buy or invest in this business for the long term. So I haven't, as I said, done anything besides a narrowing down the list, but I'm at a starting point where I'm comfortable, uh, that I hopefully will find something that I can invest in.
Yeah, those are some really interesting points. And I think a fun discussion worth having for you is kind of just like the opposite end of this. And how I would just describe it is, let's just say there's like a Roshan 2.0 out there that is not really looking at individual companies right now, but their kind of take is, I think the software industry will be fine over the long run. The software industry is down like substantially across the board, and how I'm going to save my time is I'm not going to spend time researching these individual companies. Instead, what I'm going to do is buy an exchange traded fund or a mutual fund that's concentrated in software stocks. And I think that will do just as well over the long run compared to trying to spend time finding the right software stock. And I know, it's going to be a pretty hard debate on which one is right or wrong. Only time will tell. But I think that's kind of a fun topic to discuss today, based on if you just really look at like the major indexes this year. If you, let's just talk about the S&P 500. It pretty much has been, we're towards the end of February now. It's pretty much been flat this year. If you just put your money in the S&P 500, you really haven't gone anywhere. Where in turn, if you pick some other stock to invest your money in at the beginning of the year, if you were right, you could probably be doing just, if not a lot better than the S&P 500. If you're wrong, you could be doing a lot worse. So this is kind of the debate. Sometimes you hear, just put your money in a low cost index, put your money in a low cost index software ETF, and you'll be just as fine, if not better, than somebody that does their homework or research like you, Roshan, and finds a software company to invest with. So, what do you kind of think about that kind of take?
Yeah. So um, I'm going to just change the ETF we discussed, going back to the IGV, just because it applies directly, if that's okay, versus the S&P 500. But Adrian, I don't disagree with what you said. I think what we're discussing here is how each individual, what you're comfortable with as an individual, right? As an individual investor, and also time, right? Are you going to take the time to look at it? So for me personally, specific to the risk going on in the software space, right? With this AI risk of what could be obsolete, I feel less comfortable with the ETF. Now, remember, the ETF itself has about 120 holdings. I've narrowed my list down to 12 that I'm going to look at, right? So that means of those 120 names, there's 108 I don't want to own. So I don't by any means think what you suggested is wrong. What you suggested adds it will add greater diversification. It will be less time intensive as well. And like I said earlier, it comes down to the comfort level of the individual as well. People might be a lot more comfortable with it. Now, only time will tell, but I personally like my method better because I'd feel more comfortable owning the names, and I would expect it to outperform. If I didn't expect it to outperform, I wouldn't do it. So that's where what I meant by only time will tell if I'm right or if I'm wrong. But uh, going back to your original statement of, and I'm simplifying it, and tell me if I'm putting words in your mouth, but why not just buy the ETF? I don't think that's wrong, but those are my reasons. I don't want to own all the names, and I think by doing my homework, I'll outperform it.
Yeah, and I guess I kind of just bring it up just to let our viewers and listeners know that this is kind of the decision you have to make. Do I want to look at these individual companies? Do I want to look at owning a basket of them? And that's kind of the decision you have to make and understand the risk and reward that is really associated with this. And I kind of also want to talk about like two other kind of popular names I feel like that are people are starting to hear about more, that obviously probably goes into like your research of these individual companies. And it's within the AI space. Claude and Anthropic, I believe, is like the people that are causing all this stir in the software space. And I feel like this is how it always really starts, where every year you hear this like name or this company or this product or service that burst out onto the scene. And then before we know, at the end of the year, it could be like a household name. Everybody's like, oh, it's upending the industry and everything. So can you tell our listeners and viewers a little bit more about these two names that I just brought up, and why is it causing such like a stir, and why should people like care about it or know about it?
Well, so give me one moment. I want to come back to this question because I want to make one other point that I forgot previously or missed or really thought about after. When you talked about the ETF and I talked about the greater diversification of the software ETF, that's a sector ETF. So you're diversified in the sector. What you had mentioned earlier with the S&P 500 and just own the S&P 500, that's greater diversification because that's got less in the software space. So that is another alternative as well. As you mentioned, it's been flat on the year, but if you look back the last 50 years, it's done well. So not just the sector ETF is available to you, you can also diversify greater into something like the S&P 500. Now, your next point about um, Anthropic and cloud, well, Anthropic owns cloud. Cloud. Anthropic owns Claude. Claude is really what has been the last the most recent um, cause of this. It really is what started this year. They have a model that they released, and I believe they released it previously on for businesses, and it went to individuals earlier this year. I could be wrong about that time frame, but their newest model is what's able to code so well, so quickly, and so efficiently. When someone goes on to these AI models and starts coding their own um, program, the term that's used for that is vibe coding. So with this newest iteration of Claude, uh, the concern was, will people keep buying this software, keep subscribing to this software, or can they go on Claude and just buy their own? So earlier, when I used the example of Microsoft, to me, it's unlikely that people are going to go code their own version of Word, Outlook, and Excel. Now, I did mention Microsoft has other issues, related to OpenAI, related to low adoption of their Copilot. So, um, me narrowing down that list down to 12 names, that those are just the 12 names I'm going to look deeper into. It doesn't mean we're going to invest in them. And I keep referencing Microsoft because I use it all the time, their software. So I just don't see businesses going away from it because, like, can you imagine there if I sent you my version of Word document and then you had your own version of a Word and we're trying to collaborate, they'd have to be something in between that could get them to talk to one another. I don't see people putting their time into that, right? So what I'm trying to look for are software names and companies I don't think Claude will cause disruption in. Now, the other thing I have seen with disruption that I think Microsoft is definitely at risk for is they're saying people might get either less seats, so they buy less subscriptions, or they'd get less of a duration of their subscription because somehow the AI would interrupt that. I don't know what that would be for the Microsoft Office type suite, but I also don't think that risk is non-existent. So narrowing down though, that's why with narrowing down the names. But Adrian, as your original question is Claude, which is owned by Anthropic, is what really has caused uh, this year's, the 2026 year decline on this. Now, I mentioned the decline year to date on that sector is over about 22%. But if you go back even further, 6 months, it's down about 25%. Right. So the majority of this decline has happened this year in the last 2 months, but this decline did start prior to that. And if you look at the previous high appears to be in uh, October. No, where are we? September. It looks like the IGV, the 52-week high, was at 117.98, and based on where it is now, we're talking about. Oh, I'm sorry, I did my math wrong. We're talking about a 32% decline, right, from its peak. So it's uh, the pace and how much it's declined this year has been rapid, and it's been the majority of it, right, 22%. But the decline had already started uh, in
Yeah, I
that
mean, it
space.
is interesting to see. I mean, just like we mentioned at the beginning of the podcast, the software industry has been one of the strongest industries that experiencing the most growth. And then this year, if you thought that was going to continue, you're down those numbers that you just referenced. And it's definitely something where this is where we have to just talk about like diversification again, rebalancing like your risk tolerance, how much your portfolio is like allocated, because we talk about like basic diversification or like the 60-40 approach, but if your 60 part of your portfolio is heavily concentrated in software stocks, you may think you're diversified, but then you could see some losses that surprise you a lot. And again, is AI starting to disrupt, industries like the software industry that we're talking about today. So like now more than ever, you really need to not only focus on diversification, but what sectors, what industry, if any, are you heavily or overly allocated to? Because again, this stuff, it doesn't seem like this stuff happens overnight. Because like you mentioned, Roshan, this decline has been happening for a couple months. But again, a couple months to me is not a very long time. And this stuff can quickly move on you, and you need to be ready for it this year.
Yeah, and that's another thing that will come along later in my research is do one once I narrow it down to each individual stock, I will then look at, do I think that is the stock showing signs of a bottom? I don't spend as much time on it because I'm more comfortable in finding a good business at a good price. But the timing does make a difference, right? When you're investing. And so I'd want to that is something I'd look at, and maybe based on what I'm seeing on the chart, maybe I would buy a little now and a little later, or maybe I'd wait and not buy at all. Right? Yeah, maybe I'll wait and not buy it all at this time and watch it for the future. So I don't, all of that time and effort I mentioned is all spent on trying to help me find a good business and find something I'd want to invest in. Once I'm done with the research, I might have a good business. I might have something I want to invest in, but then the timing might not be right based on, I mentioned the chart, but it could be maybe it's not cheap enough. Maybe when I'm done with the analysis, I think it's worth X, and using the old Benjamin Graham margin of safety, wanting 20 to 30% margin of safety. If it's not low enough, I might not buy. So this part of this process, it is time intensive, and it might not lead to anything today. I do think it'll be useful, because if it's not today, I think it'll lead to something in the future, or pulling a thread when you research one idea might lead you to another good idea. So, Adrian, any thoughts on that, or just anything at all with the software? Any other ideas that could help our listeners?
So I guess I feel like the one thing, it might not be really relevant to this podcast, but I talked about it before. This like these software companies having like these loans or these like private loans, or maybe this could be like a future episode as well. It might not really pertain to this, but the financial sector. I mean, if you think about it, or the financial sector and private credit and private markets are the ones really, providing these loans for these software companies that obviously are kind of like up in the air right now. And is that something too where, you're going to see it impact on a case by case, like industry by industry standpoint? Because financials have been, I think they're next in line experiencing like the most volatility after software stocks. Because again, their loans are tied to the software companies. What's kind of your opinion on that? Or what do you think viewers and listeners should look into or just know about this as well? Because, that's can be concerning where these like risky loans are out there. It kind of gives people like that, PTSD of 2008, where all these loans are going to these things that are going out of business. Is that something people should be concerned about or look into, or what's kind of your take on that?
Well, yeah, I did look at the financial sector right now. It is down as a whole this year, but it's down about 6%, I believe was the number.
Mm-hmm, mm-hmm.
Now there are, as you're mentioned, there are companies that have been uh, lending money in this space, and there have been risk with them. I have not spent that much time, any time really, looking into it. I have just um, seen the stories on them, but the one that I've seen talked about the most is Blue Owl Capital, which is down this year. Um, I think it's about 30%, 40%, and it's down 27% so far on the year to date. It's down 48% in the last 12 months. So uh, that risk is definitely there, and it's real. That is not a space I have looked at all, even though you have companies like this with the declines they have. Because when I do my personal initial review of them, they don't warrant additional research, right? At this point. I think there will be people who get in this space, find the survivors, and that'll be very profitable. But they, on first glance, they don't meet the criteria of what I look for, so I just have not spent additional time on it. But Adrian, it's as you discussed, they're extending credit. There's concerns about whether the loans they've made, whether the borrowers will be able to pay, and so the stock has come down.
Yeah, I think two other names are like KKR and Apollo Global Management. I think they're more in like the private like lending and credit space. And I guess what I'm kind of thinking about is maybe, the financial sector too is becoming a little bit more like self-conscious about all these like loans and lending, especially with AI right now? Are we kind of going to a point where it's like, all right, we need these companies, especially software and tech companies, to start really proving, these like loans that we're giving, whether that's beating on earnings, increasing their revenue. I think like another term companies are using is like, what is like our AI efficiency right now? I mean, we're spending a lot of money, and if we're not getting the return on AI, our next quarterly call is not going to be a good one when it
Good
comes
one.
out. And I
Yeah.
think, I mean, that's something too that like Wall Street and just sectors in general rely on, just like liquidity. Are there a lot of deals out there? And is there a lot of lending out there to fuel like growth and innovation? And that too could be a risk for the tech space. And like where we're seeing some of these software companies, are really getting beat up by it. I think it's just something that is on the back of my mind, where I think it's something that we're going to probably be talking about later on this year on the Retirement Lifestyle Show. That's for sure.
Yes. Yeah. That I do. It definitely an interesting space to spend time on. I just have not really started looking into it, and uh, I'll tell you, I don't know if and when I will, just based on the current numbers, right? And what I mean by that is, if I don't think I'm likely to find something I'd want to invest in, then I wouldn't necessarily spend the time on researching it. Now, you did mention a couple interesting names with KKR and Apollo, because they have had uh, pretty good histories of being well run and making some good investments. So those might be more interesting to look at. I'm looking at them as we speak. Just my two basic uh, criteria of evaluation and good business and good price. The PE on KKR, the forward PE looks pretty low, but the profitability doesn't look like something I would typically look in on their last year, but their 5-year average does. So it may be something worth looking into. As far as Apollo, uh, looking at the same thing, their shorter term numbers look better in terms of their return on equity. Their longer term don't look as good. Returns, the numbers don't look as good as KKR. Their PE is lower. So those are some where they might make the list of what's worth looking into for me going forward. When I initially looked at the Blue Owl, it didn't meet my criteria, so I don't anticipate spending much time on that one. But I appreciate you bringing them up, because the other two names are two that I'm going to put on my radar to look into at some point.
Well, I guess kind of like my final point is, I think this ties really well with the topic that we talked about on the podcast today, is also just maybe, it could just be rotation in the markets where, like we mentioned before, these like software companies, these finance companies, they have been experiencing some of the best growth and been the biggest winners these past couple of years. And they're not the only companies out there. That's not the only place you can like invest your money. And sometimes what you can see is just rotation or just like over exuberance when it comes to selling some of these like software companies. Because like you said, Microsoft, if I had to decide, is Microsoft still going to be here in the future, I would say, it is. Some of these other more riskier software companies, I don't know. And sometimes, investors are just like, maybe not like you, Roshan. Instead of like spending my time looking on these like beat up ones, I'm just going to go to another, sector industry that's maybe a little bit more stable, or maybe a little bit more has a more clear outlook, or might not be disrupted by AI, and just put my money over there, just do my research over there. I mean, that's the other kind of thing people are looking at this year. I know one of the common things that we talked about was like the S&P 500 being flat on the year, where its counterparty, which is not really a counterparty, but it's called like the equal weight ETF, where the S&P 500 has really been driven by, tech companies. Well, the reason why it's flat this year is because those tech companies are going down, but the other companies, like the other industries within the S&P 500, have been doing well and going up. That's where the equal weights have been kind of shining and experiencing more of the growth there. So that rotation, I think, is really key for our listeners and viewers today, where sometimes, people look at other areas to put their money where they're like, all right, follow where the growth is, follow where the momentum is, and maybe we'll come back to this like you do, Roshan, when things really get beaten up or things really go out of hand, so to speak, when it comes to selling, some pretty profitable companies.
Yeah. So, Adrian, that could be a certain. So, rotation means money's moving from one area to the market to the other, right? And the S&P's performance this year, the fact that it's flat, um, could uh, could line up with that, right? It really hasn't gone up or down, but if you look at the sectors, like we mentioned, the software, it's been beaten up. So I think that could line up with your thought on rotation, money being moved. However, when it comes to this software in particular, the catalyst of the decline with the new version of Claude, or the uh, what the beginning point once again being Claude, and the amount it's gone down, right? Like, I'd have to look up what the best performing sector is on the year.
If I had to
Um,
guess, it might be staples. I think consumer staples has definitely done well this year, which is interesting too, because that's been one of the sectors that, really doesn't get a lot of attention. It can be boring. It's filled with companies that, have strong balance sheets, pay a dividend, kind of your bellwether stocks that you go into when things like look risky. And that's kind of done pretty well this year because, like I said, over the past couple of years, tech has shined, and it's been the area where people put a lot of their money. But also, this is an area that gets a lot of attention, experiences the most growth. What we know goes up really fast can also go down just as quickly.
yeah, that volatility can definitely be there. Looking it up, you've got, and I'm going to read the approximate number, or the sectors in order roughly, but energy, materials, staples, that you had mentioned, industrials, healthcare are the best performers, and healthcare is really, this says it's about flat. So we're really talking about energy, materials, staples, and industrial. Energy has gone up to the similar degree as software has gone down. Uh, if you take that one out, materials are up about 17% this year, where that software was down like 23. So uh, I didn't expect the energy number to be as high as it is before I looked it up. What I expected was that energy would be down. I'm sorry, was that the software sector would be down, in that 23% or so neighborhood, and that nothing else would even be that close. So, energy, there could be an argument that software money go into energy. That's possible. I think we've got what's going on with uh, global political risk impacting the energy space. So I'd almost say energy is an outlier up because of external forces, and software is an outlier down. But that being said, I not suggesting anyone get in the software space right now. I haven't. It's just where I'm looking for opportunities.
Yeah, I mean, I think that's always good to do whenever there's like a pullback. So I feel like this would be just like a good time in like the podcast to just kind of sum up some of those like main points that you mentioned on, kind of like a 1 minute crash course on how you kind of vet these companies and look into it again for our listeners and viewers.
Well, yeah. So how we narrowed down the list, I started with a screen, and I took the holdings from IGV. I combined them, eliminated the duplicates, looked at them from a valuation metric, either price to earnings or PEG ratio, as well as a return on equity number. I then eliminated companies that I thought weren't selling that cheap, and companies that I didn't like the return on equity numbers. Now I did, on the ret- price to earnings, look at both current and forward, and included the PEG ratio. So that's my value, finding a good price, my finding a good business. I looked at return on equity. I looked at 1 year and 5 year averages. Then I looked at what analysts' outlook was, and all of that narrowed down my list to 12 names that are what I've got to do my next deep dive on. And literally, I sorted that list by return on equity because I'd rather get the good business, even if I've got to pay a little bit more for it, versus the good price side of things. But I will, sort of cherry pick some names based on what I've read and heard about the companies, personal experiences, like I mentioned with Microsoft, and that's where it is now. It's homework and additional research time. So
Awesome.
to
Yeah, I mean,
everyone
it's
that's
definitely going to
listening,
be fun. It's
it,
definitely
it
going to be
will
fun
be.
monitoring the software sector this year.
It'll be interesting, and there are a lot of swings going on in that space. So what'll be interesting is I might find one or two winners on my list of 13, or I might end up not investing in the software space at all when it's all said and done. But I am watching it closely and looking for opportunities.
Awesome. Well, again, thanks for sharing that, Roshan. It's really great having you back on the podcast today. I think some of the discussions we had today were really valuable and can really help depending on what the markets throw this way our year. And again, this is the Retirement Lifestyle Show. Please like, subscribe, check out our website. We have a lot of great content and episodes on there with whatever you're interested in. And we'll be back with another great episode.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.